Welcome, everybody, to Secret Sauce, the show where we hear real-time insights from commercial real estate industry leaders. I'm karly.iacono. Today, I am happy to be joined by Erik Oliver, the VP of Cost Segregation Authority. Erik, welcome to the show. How are you today?
I'm doing good, Karly. Thanks for having me. Excited to be here.
Yeah, we really appreciate your time. Glad you could join us. Today, we are talking about everything cost segregation related. And although this may not be the flashiest topic, I can confidently say that all of our customers and clients like to save money on taxes. So just out of the gate, we know the information is both going to be educational and relevant for all of our listeners. So we appreciate your time and look forward to diving into the topic.
Sure, no, I'm looking forward to it.
So let's start just high level. Tell us about your company and your role there.
Yeah, so again, my name is Erik Oliver. I'm with a company called Cost Segregation Authority. We're a national cost seg provider. We're kind of a niche accounting firm in our industry where we don't actually do tax returns at our firm. We just work with investors and their tax preparers across the country utilizing this specialty service around cost segregation. So your typical tax preparer doesn't have the bandwidth or the knowledge to be able to dive deep into cost segregation or real estate taxation. And so we are that source that helps them along the way. So I always look at it like your CPA is kind of your general practitioner and we're the brain surgeon, for example. So, but yeah, that's what we do. I've been doing it for 7 years now. My background is in accounting. I was looking to get out of school as quickly as I could, and math always came easy, and I hated writing papers. So I said, let's do accounting. And so my degree's in accounting, always liked real estate, and came across this job, and it seemed like a good fit, and I've loved it for the last 7 years.
Good to hear. Well, we need people who are both skilled and knowledgeable in their world. And if you love your job, that's an extra bonus. So
yes, that's
very
right.
Nice. Let's start out very basic. What is cost segregation for those listeners who've either never heard of it or never gone through a cost seg study themselves? Give us the just overview of what this even means.
Sure, no, it's a great question, Karly. So cost segregation really is just accelerated depreciation on your real estate assets. So normally real estate gets depreciated over either 27 and a half years if it's residential units or 39 years if it's commercial. And so what that means, I'll just make the math easy. Let's say you buy a $390,000 office condo. Essentially, you're going to get a $10,000 write-off, or $390,000 divided by 39. You'll get a $10,000 write-off every year for the next 39 years, which is great. That's why a lot of us go into real estate, is for these additional deductions. But what if I'm not going to own my property for 39 years? I want my deductions now. And so I want to front load those deductions versus letting the IRS hold on to them for the next 39 years. And so the way we can do that is through an engineering-based study where we identify the short-term assets in the building. So when you buy an office suite, you're not just buying the land and the walls, you're also buying some flooring, you're buying a parking lot, you're buying some window coverings. There's different components in that building that don't last 39 years. And so the IRS allows us to depreciate those over a faster rate. Now, the challenge being that when you buy that property and you give that closing statement to your tax preparer, they don't typically know the value of the parking lot. They don't know the value of the window coverings. And so that's where a cost segregation provider would come in, identify those short-term assets, which allows your tax preparer to depreciate them at a shorter rate, which means we're front loading or taking bigger deductions in the early years.
And you mentioned office condo. What other types of property does this work for?
That's a great question. Really, any revenue generating property. So it doesn't work on your primary residence because we're not allowed to take depreciation on our primary residence, but it works everything from single family rentals all the way up to large office complexes, large hospitals, casinos, ski resorts we've done. Anything that's generating revenue. I will say that in order for it to be cost effective, the basis or the depreciable basis, now depreciable basis is your purchase price minus land value. The IRS doesn't allow us to depreciate land. So your depreciable basis needs to be somewhere around $250,000 for it to be cost effective. Otherwise, yeah, you might save a little bit of tax, but it's going to cost you a couple $1,000s for the study. And so it doesn't actually pencil out. But anything over about $250,000 is worth having an analysis put together to see if it in fact could save you some tax dollars.
A pretty low benchmark in our world. So what I'm hearing is any income producing property with over $250,000 of value. So that's basically everything we have.
In this market, yes.
Yeah, so that's very good to hear. What are some of the benefits when you do this engineering study or taking accelerated depreciation and working with accountants? What does that look like in real numbers? You're getting a certain percentage cost savings on the front end. Like, kind of walk me through how this makes sense when clients go forward with it.
Yeah. So what we're doing. So again, remember, buildings are typically depreciated over 39 years. And what we're doing is we're going to identify somewhere around 30% of the building cost. We're going to reclassify that and put it into shorter asset lives. And so those asset classes are either 5, 7, or 15 years. So now we're taking a portion of what would have normally been depreciated over 39 years. We're breaking that out. And now we're depreciating it at just over 5 years, or just over 7 years, or just over 15 years. And so if you think about, let's look at $1 million building. Let's look at $1.2 million. Let's say we've got a building for $1.2 million. The land is worth $200,000. So that gives us $1 million of depreciable basis. If we can segregate somewhere around 30% of that, or 300,000 of that, into shorter asset lives, that can go from creating a deduction of 1/39th of a million, which I can't do that math in my head that quick, but it's a small number. I think it's about $30,000, to maybe having a deduction as big as $260,000. So 30,000 versus 260, that's a difference of $230,000 of additional deduction. Now that comes off our taxable income. So if you take 230,000 times a 30% tax bracket conservatively, that's over a $70,000, $80,000 tax savings in year one that we normally would not have had. And so we can then take that $70,000 or $80,000 and we can reinvest it. We can pay down our debt. There's buy a new property, a number of things we can do with that additional tax savings. So those are kind of the benefits of cost segregation, is we're creating additional cash flow up front that normally doesn't get realized until late in the game, which could be over 39 years.
It's a very powerful tool, actually one that I've used personally on investment properties, and I'm very happy that I knew about it, because it's amazing how the tax savings are created, I guess, manufactured. But it's all obviously very straightforward and following IRS regulations. It's just something that not enough people understand. So thank you for breaking it down for us with real numbers.
Yeah.
What legislation have you seen in the last few years that are changing, or maybe none, but changing the benefits of cost seg? I know there's been a lot of change to bonus depreciation. How does that play into what we're discussing?
Yeah, so that's a great question. So bonus depreciation, we haven't even touched on that, but bonus depreciation basically puts cost segregation on steroids. So back in 2017, with the Tax Cuts and Jobs Act, if you recall, Donald Trump was our president at the time. Donald Trump owns real estate, and Donald Trump pays very little in taxes. And part of the way that he's able to do that is by using depreciation. And so when he overhauled the tax code, he made it very favorable to real estate investors. So at the time, bonus depreciation was at 50%. And with the Tax Cuts and Jobs Act, it changed to 100%. Now, what that means, Karly, is any asset that has a useful life of 20 years or less, you get to take 100% of those deductions in the first year. So now normally people think, even tax preparers will say, well, Erik, this doesn't apply to real estate because real estate has a depreciable life of 27 and a half or 39 years. So you can't apply bonus to real estate. And I say, well, wait, hold up. If we do a cost seg study, we identify those 5, 7, and 15-year assets. Now all of a sudden those are eligible for bonus. So any assets that were placed into service between 9/28 of 2017, so September 28th of 17 through 12/31 of 2022, were eligible for 100% bonus. Anything that goes into service this year is eligible for 80% bonus. That's the big change from last year to this year. And then next year, it actually drops to 60%, then 40%, then 20%, then down to 0 in 2027. So what does this mean for cost segregation? Well, what it means is when we identify those 5-year assets, you get to take 80% of those deductions all in the first year instead of spreading them out over 5 years. So you're getting a huge bump in year one versus spreading them out over the useful life. And so we're able to create deductions now that investors can't even absorb because they don't have that much income. And so one of the nice things is you can actually kind of manage these deductions by opting in and out of bonus depreciation. But that's one of the big changes going forward is the bonus depreciation is sunsetting, and it all started here in 2023. Now, in saying that, I will also add that I just read an article recently that the Ways and Means Committee in Congress has put out a couple proposals to extend the 100% bonus through 2025. So we'll have to wait and see what happens in Congress the last half of this year, see if they actually get something accomplished. But if they do, they may pass that and we could extend the 100% bonus through 2025. So those are kind of the big changes for this year.
That would be exciting.
Yes, it would be
Definitely
great.
keep our eye on that. Yeah, that would be fantastic. What are some of the common misconceptions or myths surrounding cost seg that you hear a lot?
So a couple of them. One is that cost seg only works for large commercial properties, which just isn't true. Now, that was true 7 years ago before bonus depreciation kind of accelerated it even more. But now with bonus depreciation, like I said, it's put cost segregation on steroids. So the benefits are actually larger now than they were, and the fees have come down significantly. So again, we do everything, let's talk about a single family rental. Let's say you've got a $300,000 single family rental. Let's say land is worth 20% because you don't get to depreciate land. So that would be $60,000. So we've got $240,000 of depreciable basis. If we can segregate 30% of that, or 72,000, and then get 80% of that all in the first year, that's like a $56,000 deduction, somewhere in that ballpark. So at a 30% tax bracket, that's a $15,000 tax savings. So that's one of the big misconceptions is, hey, I don't have any big, large commercial properties, so cost segregation doesn't apply to me. And that's just not the case. The second is that oftentimes the question we get asked quite often is, Erik, if I take these deductions now, don't I just have to pay these back on the back end? Isn't this just a timing issue? I'm front loading this, but that just means a bigger capital gain when I sell the asset. And that's just not the case. So the way cost segregation works is you're going to take your deduction today against your ordinary income of, let's call it 40%. You're going to pay back a portion of that at a future date at 20 or 25% and save the spread. And so that's called depreciation recapture. That some of you may have heard that term, but I'll kind of back into the example because I think it makes more sense. Let's say I buy a property for $1 million today and I sell it 5 years later for $2 million. When I go to settle up with the IRS, I'm telling them that everything has doubled in value, right? I bought all this stuff for $1 million. I'm now selling all this stuff for $2 million, and they're going to charge me tax on that. Well, my walls have doubled in value. My land might have doubled in value, but certainly my dirty, nasty carpet that's 5 years old isn't worth double what I paid for it.
Right.
And unfortunately, when we don't do cost segregation, we don't have the ability to pull the carpet out because we just have everything lumped together. And so by doing a cost segregation study, it allows us to allocate our sales price to the right bucket. So we're going to say, yeah, we sold it for more, but that gain was on the building, not the carpet. And by doing so, it creates a permanent tax savings. So that's a little bit complicated. I don't want to get too far in the weeds, but if you can remember one thing, just don't sell your dirty, nasty carpet for more than you bought it for. And if you don't do cost segregation, that's what you're unintentionally doing. So.
No, I think that's a fascinating point on depreciation recapture. I actually did not know that you could forward look from the cost segregation study and allocate the increase in value to the walls instead of the things that had already been depreciated on an accelerated basis. That's sure. I think that's really, really good information.
Yeah, because if you think about it, in that example, I said we had it for 5 years. What is my 5-year carpet worth after 5 years? It's worth zero.
Right, exactly. So the opposite. Mm-hmm.
Right. So we shouldn't be selling it for double what we paid for it. That's just silly.
Right. No, that's a great distinction. I love that. Very interesting. How do you work with accountants? Because one of the misconceptions that I hear a lot is, I've already spoken to my accountant. There's nothing else we can do. And no knock on accountants. There's some wonderful ones, and they're incredibly important to our industry. But how do you educate those clients and say, no, we're going to work in tandem with your accountant. It's not an either or, and it's nothing against your current accountant's advice. So how do you kind of bridge that gap or misconception?
Yeah, that's a great question, because that's a tricky one, because sometimes, I'll be honest with you, we work with a ton of CPAs. I love CPAs. They're great people, but they don't all specialize in real estate. And so the tax code is thousands of pages. And so they can't be an expert in all these different areas. And I'll go back to that analogy I used earlier, where your CPA or your tax preparer, they're kind of your general practitioner. They know a little bit about a whole wide array of subjects. Where we just dive deep in this one subject. I don't know anything about earned business income or child tax credits, because that's not what I specialize in, but I do know a lot about depreciation. And so we like to partner with them early in the process. Sometimes that can be tricky, because maybe you, as their client, you paid a big tax bill last year when you own these properties, and we're coming in saying, hey, you shouldn't have paid that big tax bill. So sometimes it gets a little tricky. But we always want to partner with them, because they know your financial situation, Karly, way better than I do. So cost segregation is not for everybody. And so we need to partner with them to identify, hey, does this actually work for Karly? Does she have other deductions that maybe are carrying forward from last year? Does she have passive loss or passive income limitations that she can't utilize these deductions? There's a number of things that we need to identify. And so our goal here at Cost Segregation Authority, and most cost segregation companies, will be to get the CPAs involved early, because there's nothing, I don't want you to pay for a report, then you give it to your report, the report to your tax preparer 2 days before taxes are due, and say, hey, this guy told me I could save a whole bunch of money if I pay him to do this report. And then your CPA is like, well, you're not a real estate professional, or you've got no passive income this year, so you can't utilize it. So that puts a bad name on us and a bad name on everybody in the industry. And so we like to partner with them early as possible in the process.
So not either or, it is a collaboration, and both very different specialties.
Yeah, exactly.
Important distinction.
Yes.
Are there any other challenges that you're facing? Could be given economic conditions or just in the industry at large, that are affecting your course of business?
Obviously with interest rates being higher, there's fewer transactions. We're kind of in a unique business where we're a little bit sheltered from what's going on in the economy. The reason for that is, yeah, there are fewer transactions happening in the market right now because of rising interest rate costs. But because of that, people are looking to generate more cash flow. And one way they can do that is by reducing their tax bills. So I like to use the analogy, oftentimes as investors, we're too focused on adding more doors, or adding the next retail shop, or adding the next, multifamily building to create more revenue, obviously. But sometimes we can create more revenue or more income by just reducing our tax bill. And that gets missed sometimes. I played sports growing up. I played basketball, and sometimes it doesn't matter if you score 120 points a game. If the other team scores 121, you still lose, right? If you don't play defense, it doesn't matter how much offense you play. And so I look at the tax side of things as kind of the defense. Yeah, you can grow your portfolio. You can grow your income by adding more properties, but you can also grow your income by reducing your tax bill. And too many people lose focus of that part. And so with the economic times that we're in, with the rising cost of interest rates, transactions are down, but people are definitely looking for ways to increase their cash flow. And looking at your tax situation is a great way to look at potential opportunities to reduce that tax liability and increase your overall cash flow.
So it could be a good thing to look at during your whole period.
Yeah,
which kind of brings me to one of my last questions for you, and that is the timeline. You alluded to, obviously, the changes in bonus depreciation that we're all very well aware of, the phase out. If someone bought a property in 2019 and they've not done a cost seg study, can they still do one? And if so, how does that interact with bonus depreciation? Is it 2019 levels, because that's when the property was put into service, or is it unfortunately whatever is offered that current tax year?
No, the great news is it is based on the in-service date. So if you've got properties that you've purchased in the past, you've never done cost seg, you find yourself in the current year with a tax liability, you can actually go back, do those studies, bring those deductions forward, and take the deductions in the current year. And the bonus percentage is all based upon when you place the building into service. So in that case, if you put it into service in 2019, In 2019, the bonus was at 100%. You get the 100% versus the 80% because it's based on the in-service date. So, and not only that, but you can actually do a cost segregation study. The cost segregation studies don't need to be done until you file your taxes. So really, we have until next October, if you extend, to get cost seg studies done for the 2023 tax year. Now, I'm going to put this out there for your CPAs. They don't want you to wait till next October to get these studies done. Get them done sooner than that. But in theory, you have until October of 2024 to get your cost seg studies done for 2023, because we just need to have the numbers provided to your CPA before they file your tax return.
That's great. And the fact that you can do a look back if you haven't taken advantage of this yet is extremely helpful. Is there a cap on how many years you can go back for cost segregation?
There's no cap, but usually anything over about 15 years old is probably not going to pencil out because you've already taken a good chunk of the depreciation. Right. So there's not a lot for us to pull forward. So I would always recommend to clients or potential clients, hey, if you've got any assets that you've purchased in the last 15 years, let's take a look at them. Let's run the analysis based on what the laws were at the time you put it into service. And let's see which of your properties make sense. And some may and some may not, but having the numbers is key to be able to make that determination.
Very, very interesting. That it does not have to be in the near term and could go back maybe even up to 15 years and still make sense. So good advice. And especially during this period in the market when everyone's sort of doing portfolio management and figuring out their strategy moving forward, I think this is a great thing for our clients and investors to consider if they haven't looked at cost seg before. It might be a very important tool to maximize cash flow in an otherwise challenging climate.
Yeah, absolutely.
Thank you for sharing all of this great advice. We appreciate it. Anything to add value to the commercial real estate industry is always welcome, and we very much appreciate your expertise today. Thanks for being on the show.
Thank you for having me. It's been great.
My pleasure. To everyone listening, that was Secret Sauce. We're really happy that you tuned in, and we look forward to seeing you again very soon. Have a great day, everyone.